Hey y'all, welcome back to the channel. Today we're going to be talking about growth stocks, value stocks, how they're similar, how they're different. Before we get started, I'm just going to do a quick financial disclaimer. The information provided on this platform is for educational and informational purposes only and does not have a constitute financial, investment, or legal advice. I'm not a certified financial advisor. Please consult with a licensed professional before making any financial decisions. So firstly, let's talk about growth stocks. What are growth stocks in general? Typically, growth stocks are companies that have a high chance for growth or share appreciation in the near future. So what would be some characteristics? First of all, high PE ratio. So PE ratio stands for price to earnings, and it's basically how much money do you have to pay to get $1 back in earnings of the company. So a PE ratio of 20 to 1, meaning for every $20 of shares I own, I get $1 back in earnings technically. When it comes to percentage of the company. So when it comes to a growth stock, typically the PE ratios are going to be high because you have to pay a premium for the expected growth of the company. So a company like Tesla obviously has a very high PE ratio of like 350 because you're paying a premium for the potential growth that the company may have. Another characteristic is volatile. Because a lot of these companies, when it comes to their earnings, or if they're a technology company, maybe experiment or whatever, like a new product launch, they can be very volatile up and down. Think Apple when like maybe a new iPhone comes out or sales, whatever. Like they can be very volatile. They're much more susceptible to interest rates and other maybe international conflicts. Another one is lower or no dividends. Because these are high growth companies, they're investing most of their earnings back into the company. So think like Amazon. They don't pay out a dividend, and they continue to reinvest all earnings back into the company, all earnings profits. And some examples, like we just mentioned, Tesla and Nvidia are two popular examples. Tesla having no dividend and a PE ratio of, I think, 350. Nvidia having a very small dividend and a PE ratio of, I think, in the 50s. So those are some two good examples. So now let's talk about value stocks. In general, value stocks are typically stocks that are undervalued or cheaply valued by the stock market. We can usually tell this by their lower PE ratios that are usually below average relative to other stocks in the S&P 500 or just in general. Another thing, they usually have lower volatility. The typical value stock is usually relatively well developed or a blue chip stock. So they have more proven spreadsheets, incomes, they're more of an established company. And unlike growth companies, their value isn't too determined on the whims of the market, interest rates, or potential product launches. It's typically much more stable. And because they're more developed usually and less growth centered, they usually pay a higher dividend. Think maybe 2-3%. Some famous examples of value stocks usually come up with some blue chip companies like Johnson & Johnson, Procter & Gamble, and Coca-Cola. What type of market conditions are best for each type of stock? So firstly, when it comes to value, it says higher interest rates in bear market. This doesn't necessarily mean you're going to get a high return on investment with a value stock in the case of like a recession. Since these companies are typically more developed and blue chip, they tend to crash less, or they tend to be less negatively impacted by, let's say, a recession. So when it says that's an ideal market, that's typically when they outperform because they simply don't go down as much as, say, growth stocks. So that's usually where that outperformance comes in, not necessarily in a positive way, but in just really a less negative way, if that makes sense. As opposed to growth stocks, low interest rates, bull market. So I think the last like 15 years or like post 2008 stock market, low interest rates, high growth for like tech stocks. Because they are trying to grow their companies, lower interest rates, they can borrow money more cheap, so it's cheaper and easier to grow. A pretty good recent example of where we see this bull market caused by low interest rates is kind of the post 2008 last 15 years of the stock market. This is where we saw a lot of the modern tech stocks really take their place, like Apple and Tesla. Caused by these low interest rates, these companies grew very rapidly over the last 15 years and generated very high returns and outperformed the market by a great amount. So just to end the video off, I'm just going to show y'all a basic comparison between two stocks. For our growth stock, we have Tesla in blue, and for our value stock, we have Coca-Cola in orange. Now, first, just looking at price action over the last 5 years, we're looking at Tesla, we see a lot of price variation. We see a lot of peaks and valleys in short amount of time. Obviously, a lot of volatility here with a spike and then crash. And it's kind of harder to see a general trend than we see with Coca-Cola. Like, obviously, we see a massive downtrend here it kind of remains relatively flat for a while. We see a spike and then a downtrend, but then it kind of slowly rises. But then when we look at Coca-Cola, it seems almost completely flat to Tesla. Obviously, there is some price variation, but relative to Tesla, it is much more stable. We can see a very clear, slow uptrend over the 5 years relative to Tesla, which is much more all over the place. Scrolling down, just looking at some more stock statistics, we look at PE ratio. For Coca-Cola, it's $26. And for Tesla, it's 370. So we really see the high PE ratio for growth stocks here, and the low PE ratio for value, as Coca-Cola's PE ratio is less than 10% of Tesla's, which is kind of wild, honestly. Just another thing with dividends, we see Coca-Cola being that blue chip value stock, 2.5% dividend. But Tesla, again, no dividend, as it is a growth stock. They're trying to reinvest all earnings and profits back into the company for future growth. Thank you all so much for watching today. As always, if there's any mistakes I made, please feel free to correct me in the comments. Thanks for watching to the end. I'll see y'all next time.